Hello all. Students seem to be having trouble analyzing transactions and their effect on the accounting equation and then journalizing them with debits and credits. So I'm going to go over this drill that we did in class yesterday. You have the sheet at home, so you should have the spreadsheet sitting right in front of you as I go through this. I'm going to go through this rather quick because we did it during class. But hopefully this will reinforce what we've done in class yesterday. The chart of accounts for the company is listed in the upper left-hand corner. A through T lists all the accounts we will use as we analyze these transactions. Transaction 1 says issued common stock to investors. Well, if we issue common stock to investors, we're getting cash. Cash is an asset, so we debit A, and common stock is a stockholder's equity account. We credit K. The effect it has on the accounting equation is assets will increase because our cash increase, and so will our stockholder's equity. Transaction 2 says purchase supplies on account. The two accounts involved are supplies and accounts payable. Supplies is an asset. Assets increase on the debit side, so we will debit the letter C. Accounts payable is a liability. Liabilities increase on the credit side, so we will credit G. In our accounting equation, you can see that we've increased our assets and we've increased our liabilities. Both have increased. In number 3, we receive payment for services provided to customers. If we receive payment, that means cash is increasing. So we debit the letter A for cash. We credit the letter O because if we provide services to customers, that means we're generating revenue. And O is service revenue. Revenues increase on the credit side. So our assets are increasing, and so is our stockholders' equity. And the reason why stockholders' equity is increasing is because we have revenue, and that revenue ultimately increases retained earnings. On number 4, we paid salaries for employees. So if it says paid, that means cash is going out. What are we paying for? Our salaries. So we have salary expense and we have cash. Salary expense is an expense. Expenses always increase on the debit side, so we debit R. We credit A because we're paying cash out. Cash is an asset and assets decrease on the credit side. So if you look at the accounting equation, assets decrease because we're paying cash out. Stockholders' equity decreases because we have an expense that's increasing. Expenses, once they take place, cause retained earnings to go down. Retained earnings is part of stockholders' equity, so that's why we have a decrease in stockholders' equity. On number 5, we say purchase equipment for cash. Well, if we're buying equipment, then equipment is one account and cash is the other. Equipment is an asset. We're going to debit it, so we debit F. We're going to credit cash because cash is being paid out. So when we look at the accounting equation, we had one asset go up, so I put an I there, and we had one asset, cash, go down, so I put a D there. On the next one, it says recorded cash sales. So this is a way that we say we sold stuff to our customers and they paid us cash. Well, the two accounts then are cash and sales. Because cash is an asset and it's increasing, we debit A. Sales is a revenue account. So in this problem, we have two revenue accounts. Letter N is for sales. You use sales when you sell a product. And O is for service revenue. So we use service revenue when we provide a service. This company sells a product as well as providing a service. So we debit A for cash and we credit N for sales. Again, look at the accounting equation. If you look at the accounting equation, we increase assets because cash went up. We increase stockholders' equity. Why? Because any increase in revenue will cause retained earnings to increase, and retained earnings is part of stockholders' equity. Record sales on account, number 7. Now, we still sell goods to our customers, but this time they don't pay us. They owe us, so we debit B, accounts receivable. Accounts receivable is an asset and represents what customers owe us. We're going to debit that because it's increasing, and we're going to credit in sales because sales is a revenue and the increased side is the credit side. Again, what we'll do is we'll increase our assets. We're increasing our stockholders' equity because any increase in revenue causes stockholders' equity to go up. Number 8 says received advance payment from customers for services to be provided next month. So in this problem, the two accounts involved are cash and deferred revenue. Cash is involved because it says receive payment. Anytime it says receive payment, that means cash is going to increase. Now we're receiving payment from customers for services that are not being provided at this time. So once we get their money, we owe them services. The account we use in accounting to keep track of what we owe to our customers is called deferred revenue. Deferred revenue is a liability account. In this case, both accounts are increasing. Cash is increasing, and so is deferred revenue because we now owe our customers a service. So what we do here is we debit the letter A to show the increase in cash, and we credit H because H is deferred revenue. Deferred revenue is a liability, and the increased side for any liability is the credit side. If we look at the accounting equation, we have increases both for assets because cash has gone up, and increases for liabilities because of the increase in deferred revenue. Number 9 says borrowed money from the bank. The two accounts involved here are cash because we're borrowing money, and notes payable because we're borrowing money from a bank. When you borrow money from a bank, you sign a promissory note. Cash is an asset. Cash is letter A, so we're going to debit A. Notes payable is a liability. Notes payable is letter J, so we're going to credit letter J. Both the asset and the liability are increasing. When we look at the accounting equation, we see increases for both assets and liabilities. Number 10 says paid rent in advance for the upcoming year. The two accounts involved are cash because it says paid rent. What do we pay with? We pay with cash. For the upcoming year, in other words, we're making an advance payment on our rent. When we make an advance payment on a rent, it's an asset because there's a future benefit there. The asset's called prepaid rent. So the two accounts are prepaid rent and cash. The asset prepaid rent is increasing while the asset cash is decreasing. So what we'll do here is we're going to debit letter D for prepaid rent, and we're going to credit cash. Now in the accounting equation, you see that we have an I and a D in assets because we have one asset going up, prepaid rent, and another asset going down, cash. In 11, we're paying for advertising campaign that will run during the next 6 months. The two accounts here are cash and prepaid advertising. cash because it says paid. When it says paid, we're paying with cash. Cash is an asset. Prepaid advertising is also an asset. And the reason why it's an asset is because there's a future benefit to it. We're going to run a campaign during the next 6 months. So that's the future benefit. So the account prepaid advertising is used. So again, what we have here is one asset going up or increasing and the other decreasing. We're going to debit letter E, prepaid advertising, and we're going to credit A for cash. Again, if you look at the accounting equation, you'll see an I and a D under the A. Assets are increasing because we've increased our prepaid advertising account. Assets are also decreasing because we paid cash out. Number 12 says we're recording the utility bill that will be paid next month. The two accounts involved in this one are utility expense and accounts payable. Utility expense is an expense, it's increasing. Accounts payable is a liability, and that liability is increasing. Now, accounts payable is used because we're not paying our utility bill this month. If we were paying the utility bill at this time, we would use cash. But because we're not going to pay it until next month, we use accounts payable because we have a liability at that point in time. So we're going to debit S for utility expense, and we're going to credit G for accounts payable. On the accounting equation, you see that liabilities increase and stockholders' equity decreases. The increase in liabilities is because of accounts payable. We owe the utility company. The decrease in stockholders' equity is because of the utility expense that we're incurring. Anytime you have an expense, it causes retained earnings to decrease, and retained earnings part of stockholders' equity. So stockholders' equity decreases as well. Number 13 says that we recorded salaries that will be paid next month. This is similar to number 12. In this case, we have an expense and we have a liability. The expense this time is salaries expense, and the liability is salaries payable. Again, we have an expense because we've incurred that cost. The salary expense account is R, so we're going to debit R. The salaries payable account is letter I, so we're going to credit letter I. When you look at the accounting equation, we're going to have an increase in our liabilities and a decrease in our stockholders' equity. The increase in our liability is because of the salaries payable. The decrease in stockholders' equity is because of salary expense being an expense, and we keep saying that expenses cause retained earnings to go down, so they cause stockholders' equity to decrease as well. Number 14 says we're recording supplies that were used during the month. Okay, earlier we bought supplies. When we bought supplies, we treated them as an asset. As we use those supplies up, they become an expense. So the two accounts involved in this transaction are supply expense and supplies. Supplies expense is an expense, and it represents the amount of supplies used that we had previously purchased. So it's increasing. Our supplies, on the other hand, are the asset that we had previously purchased and we used up. So supplies as an asset have gone down. So we debit supply expense, in this case supply expense, is T, and we credit supplies, which is letter C. In the accounting equation, you see that our asset supplies is decreasing and our stockholders' equity is decreasing because we're reporting supply expense. 15 states that we're recording the rent expense for the month. Now back in number 10, we paid for rent in advance. So when we made that advance payment of rent in number 10, we debited prepaid rent. Now in transaction 15, we're recording the use of 1 month of that rent. So the two accounts involved are going to be rent expense and prepaid rent. Rent expense is an expense that's increasing, so we will debit Q. Prepaid rent is the asset that we recorded previously. It's decreasing because we've used 1 month up. So we're going to credit the letter D. On our accounting equation, you can see that our asset goes down or decreases, and so does stockholders' equity. Stockholders' equity goes down again because rent expense is an expense, and that causes a decrease in stockholders' equity. Number 16 says that we provided services to customers and that we'll bill them at the end of the month. The two accounts involved here are accounts receivable and service revenue. Accounts receivable is an asset. We're using accounts receivable because we haven't got paid for services that we've provided. They owe us. We're going to bill them. Accounts receivable is increasing. The other account involved is service revenue. We've provided the service, so we've earned the revenue. Revenues are going up as well. So in this case, what we'll do is we'll debit B for accounts receivable, and we'll credit O for service revenue. In the accounting equation, you can see that assets go up because that represents the increase in accounts receivable. Stockholders' equity goes up as well because revenues cause an increase in stockholders' equity. On number 17, we're paying for supplies that we purchased previously on account. The two accounts involved here are cash and accounts payable. Anytime we say paid, it means we're paying cash. Cash is an asset and it's decreasing. Accounts payable is a liability, and because we're paying it down, there's a decrease in the liability as well. So in our debits and credits, we're going to debit the letter G, accounts payable, and credit the letter A for assets. In our accounting equation, the accounting equation will show that we have a decrease in assets to represent the decrease in cash and a D in liabilities to represent the decrease in accounts payable. In number 18, we say receive payment from sales on account. So we had made sales in the past on account, and we're finally going to collect the money from the customers. So anytime it says receive payment, that means cash is involved. If we're receiving payment on account, that means our customers who owed us money are paying us off. So the other account is accounts receivable. So we're going to debit the asset A, cash, because we have an increase in cash. And we're going to credit the asset accounts receivable, letter B, because we have a decrease in the asset accounts receivable. In our accounting equation, we have both an I and a D in the asset column because we have one asset increasing, cash, and another asset decreasing, accounts receivable. Number 19 says that we paid for the current month's newspaper advertising. Two accounts involved here are advertising expense and cash. Advertising expense is increasing. It's the letter P, so we're going to debit P. Cash is an asset decreasing, so we're going to credit A. The reason why we're using advertising expense instead of prepaid advertising is that earlier, when we used prepaid advertising, we were paying for an advertising campaign that was going to be delivered to us at some point in the future. In this transaction, we're paying for the current month's advertising in the newspaper. There's no future benefit to it. It's over during the month. When there's no future benefit, you have a cost and you record that cost as an expense at the time you incur it. So we're going to debit advertising expense. Now in the accounting equation, you can see that assets go down because cash is being paid out, and so does stockholders' equity. Stockholders' equity is decreasing because we have an advertising expense, and expenses cause a decrease in retained earnings and stockholders' equity. On number 20, we pay dividends to stockholders. The two accounts involved here are dividends and cash. Dividends is a stockholders' equity account, but it's a stockholders' equity account that increases on the debit side. So we call it a contra stockholders' equity account because both common stock and retained earnings increase on the credit side. With dividends, we have an increase on the debit side as opposed to the credit side. Because of that, it's called a contra stockholders' equity account. So for this problem, we'll debit M because dividends are increasing, and we'll credit A, cash, because we're paying cash out. On the accounting equation, we'll decrease our assets because cash is decreasing, and we'll decrease stockholders' equity because dividends cause stockholders' equity to go down. Make sure that you realize that dividends are a stockholders' equity account and not an expense. They are never an expense of the company. They represent a return of earnings to the owners of the company. 21 says that we paid a utility bill that was received last month. The two accounts involved are cash and accounts payable. Now cash is obvious because it says that we paid a bill. So we paid with cash. Cash is an asset. Cash is decreasing. So we're going to credit cash. We're going to credit A. The debit is going to be to accounts payable. So we're going to debit G because the debit side is the decrease side for a liability. The reason why we use accounts payable is because we received this bill last month. When we received the bill last month, we debited utility expense and credited utility payable. So we recorded the expense in the month that we incurred it, and we recorded that liability because we didn't pay it during that month. At this point, we're paying it. So we have to decrease our liability. We're debiting accounts payable to do that. On the accounting equation, you can see that we decrease assets, and that's our cash, and we decrease our liability because that's our accounts payable. Number 22 states that we provided services that had been paid for in advance. Now remember, when people pay us in advance of us providing the service, we get the cash, but we also use the account deferred revenue to show that we owe them services. So at the time they pay us in advance, we debit cash and credit deferred revenue. At the point in time where we deliver the service, then we reduce our liability. So we're going to debit deferred revenue, which is H in this case, and we're going to recognize the fact that we earned the revenue. So we're going to credit O, service revenue. In the accounting equation, we're going to show a decrease in our liability because we don't owe them anymore for the service. And we're going to show an increase in stockholders' equity because revenues always increase stockholders' equity. So at this point, I'm hoping you have a better understanding on how to record transactions as debits and credits, and also how to analyze the transactions in terms of their effect they have on the accounting equation. Now I have a few questions below the transaction table that you should become familiar with. The first question asks that you determine the ending cash balance. And it says that you have a beginning cash balance of $10,000. So look at the T account here. I have a beginning balance of $10,000. The beginning balance is on the debit side because all assets, expenses, and dividends have debit balances. In the debit side, I list every time we debited the letter A. So we debited the letter A on the 1st, the 2nd, the 6th, the 8th, the 9th, and the 18th transaction. We credited cash on the 4th, 5th, 10th, 11th, 17th, 19th, 20th, and 21st transaction. To calculate the ending balance for any account that has a normal balance of a debit, and that's assets, expenses, and dividends, you first add the debit column up, and then you subtract the credit column. So in this case, we start with the beginning balance of $10,000, add all the debits below it, then subtract all the credits, and we get an ending balance of $245,000. That ending balance will be on the debit side because the debit column will be greater than the credit column. Question 24 asks you to determine the ending balance for accounts payable and to assume a beginning balance of $6,000. Well, let's look at the T account for accounts payable. Accounts payable is a liability. And liabilities, owner's equity, and revenues always have credit balances. So the beginning balance of $6,000 is on the credit side. Accounts payable is letter G, so you look at your transaction sheet and you'll find all the letter G's, and you'll see that we credited accounts payable for transaction 2 for $10,000, transaction 12 for $8,000. We debited it for transaction 17 for $10,000 and transaction 21 for $6,000. So to get the ending balance, you'll take the credit beginning balance of $6,000, add the credits of $10,000 and $8,000 from transactions 2 and 12, and subtract the debits of $10,000 and $6,000 from transactions 17 and 21. The credit amount will be larger than the debit amount, so you'll end up with a credit balance of $8,000. The ending balance is a credit of $8,000, and it will always be a credit balance for liabilities, owner's equities, and revenues. The next question asks you to determine the net income for the period. Well, you know that net income equals revenues minus expenses. In this problem, you had two revenue accounts. You had letter N for sales and letter O for service revenue. So to get your total revenues, you'll add up all the N's and all the O's. You'll notice that all revenue accounts just have credit amounts posted to them. So when you add up your revenues, you have $184,000 in revenues. Then you'll add up all your expenses. For this problem, your expenses were letter P, Q, R, S, T. So you'll add all those expenses up. All the expenses were debited. When you get a total there, the total should be $94,000. To get the net income, you'll subtract the $94,000 in expenses from the revenue of $184,000, and you'll get a net income of $90,000. The last question asks you to determine the ending balance in retained earnings. They give you a beginning balance in retained earnings of $50,000. So to get the ending balance, you take the beginning balance, add the net income, and subtract the dividends. In this problem, the beginning balance is $50,000. The net income we just calculated at $90,000, and we know that the dividend was from transaction 20 of $5,000. So 50 plus 90 minus 5 is $135,000. The ending balance in retained earnings is $135,000. Well, that's it. I hope this video helps you to better understand debits and credits, how transactions affect the accounting equation, how to calculate balances for T accounts related to assets, expenses, and dividends, as well as liabilities, owner's equities, and revenue, how to determine the net income from a series of transactions, and how to calculate the ending balance in retained earnings. If you watched this video from the beginning, I appreciate your effort and commitment to learning. Good luck with this stuff. Hope this helps.